All right, cool. Chapter 2 and chapter 3. So anything to do with price arrays and anything to do with chapter 3. So let's go over one thing because I had quite a few questions today again on mitigation blocks because there's some people that joined, isn't it? So let's go over what mitigation block is. Let's go on DXY. So can anyone see a mitigation block here in any of these candles? Is there a mitigation block here? Remember what it is, yeah? So if you're looking for a bullish mitigation block, you need to identify a failure swing low, right? Now, what's a failure swing low? Essentially, it's just, so you see this move up, see how this retracement comes down, but it's not beating this low, right? It's just offering a retracement and then you go higher, right? That's what you're looking for. That's the first thing your eyes need to be trained to look for, right? A move higher, a failure swing low retracement, and then a break above the high here. And where the mitigation block is, it's the high in the bullish context, it's the highest up close candle prior to the failure swing low and then the move up again to break the high. Now to reverse that, it will be a bearish mitigation block, right? So you see this is the bullish mitigation block, comes in, the candles overshoot it a bit, but if you look at the candle body closes, you'll see how it's respecting, heavily inside of the mitigation block. That's what a mitigation block looks like. If I just move this down. How do I fix this? Maybe if I go back on my trading view, it'll fix it up. Does anyone know how to fix this?
On the right.
Oh, this is this, yeah.
Bottom.
Yeah.
Right. You see what's highlighted blue?
Yeah, I got it. All right. Now for the reverse of that, if you go into euro, it should be a opposing mitigation block, right? If we go on the weekly, I believe. So on the weekly, right? We see this retracement higher, right? We see a few of them. You see how there's this retracement higher and then the move down. The lowest down close candle before the failure swing high, and then when you break below this low, that becomes a mitigation block, right? So this is the mitigation block, right? This was a mitigation block here, and this is now a mitigation block as well, right? You see how they're the lowest down close candles before the move up, lowest down close candle, the move up, lowest down close candle before the move up, right? Those are examples of mitigation blocks. Anyone have any questions to do with chapter 2? Are you struggling with any price arrays to find them, or you're not understanding the price array, you struggle finding them, or how to frame entries around them?
So you see the mitigation blocks, yeah?
Yeah.
So is that just the failure swing high, like for the previous high? So I just choose any high now, yeah?
All right. What, in a bullish context or bearish context?
Bearish.
Okay, so any high. Okay, so let's take this high.
Yeah. So the mitigation block, with that, okay. So the last down close candle before the retracement up and then the move lower?
Yeah, this one.
Yeah, that's a mitigation block, isn't it?
Yeah, that's the mitigation block.
Yeah, but is it to the high, to the left of that?
To which one? What, this one?
Yeah.
Yeah, so you see how forget this price action happened, right? You see when we made this swing point and we moved down to make this low, this was the high and this was the low, innit? right?
Yeah.
Now, you know how you're going to retrace up, offer a retracement up before going down, right? That's how a market moves, isn't it? Right? When that happens, when you retrace higher,
Yeah.
right, and you move down again, and a new range is created, you're looking for a mitigation block or a breaker block is always created. When a new price range is created, price range meaning when the external range is broken and a new range is made out of that. So for example, it was from here to here, right?
Yeah.
And then when this low broke, now it's from here to here. That's the new range, right?
Yeah.
Whenever external range is broken, a new price range is created. A new set of price arrays is created. All the price arrays are, this is like your structure to the range. You'll see that price arrays,
Yeah.
they make up the the price arrays make up the price range that you're in. Now, when you make a new price range, you're gonna have your mitigation block, right? You're gonna have your fair value gap, right? And you have your order block and you have
Yeah.
a rejection block. Now, if you've done all of the lessons in chapter 2, you know that that is the order that we expect them to come in. There's a specific order that these price arrays are usually found in when a price range is created. First comes the mitigation block or the breaker block, right? It's either going to be a mitigation or a breaker, right? And then what you'll have is fair value gap, right? And then after fair value gap, you'll have order block. And the thing before the high is, right? Before the high is this rejection block, right? It's the wick inside. And then you have the actual high of the high of the range, right? That's how a price range is formed, right? So
Yeah.
whenever you see your swing high to swing low, that's the first thing you do, right? When you're a trader, you need to identify what is the price range that I'm working in, right? Because now within that price range, I'm going to find what is expensive and what is cheap relative to that price range. And I'm going to give you a
Yeah.
real life example of that. You see in trading, you hear a lot, especially on maybe YouTube, you hear the old classic, let me buy low and sell high, you know? Okay, but what is low and what is high? These things are important to define. Do you see my point? It's very important to define these things. Now, the way we're defining them is relative to the price range. Does anyone know what relative means, by the way? Or because I know some people may be younger here, and relative is a term you'll hear when you're doing like A-level maths or economics. Relative
Maybe
just
like in
means,
context.
yeah, in the context, exactly. So relative to this price range, in the context of this price range, that's how you have to look at it, like when you're trading, right? Because if we're looking at high or low, and we're taking the all-time high price of Euro USD and the all-time low price, that's not the price range we're dealing in right now, right? And I'll give you an example. Let's take the shoe market, Air Forces, right? Now, let's say the market of Air Forces, you want to buy and sell them. Well, of course, you always want to buy and sell, you always want to buy your Air Forces low and you want to sell them high, right? But as someone that's selling Air Forces, yeah, are you going to sell them at £300? If
No.
no, why? Because the premium of the market is at 150, right?
Yeah. Yeah.
Yeah. Why would you sell it at 300? That's not even in the price range. It has to be relative to what are the prices today. What are the current prices I'm dealing in today? Do you see my point?
Yeah. Okay. Okay.
Yeah.
Yeah. That makes
This
sense.
the same is applied to trading. What is the current price range, the current trading range that I'm dealing with? Yeah. So you identify that. You identify your swing point, swing high, and swing low. Take the most obvious one, right? Clearly, this is obvious. Look, high and low. Now you're working within this range, right? Now you're determining if you want to be a buyer, what do you need to do? You need to buy it when it's cheap in the range, at the low end of the range. This is how you start to buy low. Now, what is low of the range? Anything that is discount, right? So if I look, now we have this, right? 50%, anything beneath that is a discount market. Anything above that is a premium market, right? And the 50 itself is fair value of the market, right? Now, when you're a buyer, you want to be buying at the 50%, beneath the 50% of the range, right? Now, when you're selling and you want to look to sell, you need to exercise your patience, wait for the market to deliver into a premium, and then try to then find your short setups. It's not just of when you're looking for your bias, right? Now, this is the weekly chart, right? Let's say we trade up higher into this premium and you see this order block together, right? And we start to reject off that order block. That's what you're trying to look for. You're trying to look for the rejection off of the premium. Now, where in the premium, this is where the arrays come in, right? Within the premium, you're looking for the specific areas where it makes sense to reject off of. This is where you look for your specific arrays. Now we see that we have fair value gap, right? You see this gap in this candle. We have that. We have order block. So those are, you know, specific references to price, right? That we can expect the market to reject off of. And that's how we would, on the weekly time frame, that can help us build our bias. Because now let's say the next week, this weekly candle, the next one, it trades into this order block and you see like it's got like wicking down away from it. What do you think the next candle is going to do, right? You think the next weekly candle is likely to carry on the rejection off of it, or is it likely to carry on?
Rejection.
Exactly. Now, that candle in this context of the weekly time frame shows how much of price action, bro. It shows a day's worth, an hour's worth, a week's worth. How long does it show?
A week's worth.
A week's worth. So that rejection of the weekly to carry on and make a down close candle off the rejection, that's how you build a weekly bias. The next weekly candle is,
that the days will be like down closes, isn't it?
yeah, and then going into that week, right? You'll look for going into sells, right? Unless your bias is off and the next candle goes higher and higher, right? Then that's fine. Then you get back in line. This is trading, right? You're never going to get it right every single time. Your bias is going to be off. I've had times my bias is off, right? Like things like that happen. You can't always, you know, 100% of the time get it right. And that's completely fine. It's about adapting as well midweek, right? But just something this small, this powerful, just understanding the premium, the discount, and the arrays within it, it is the backbone of your trading because you're going to use it for everything. You're going to use it to frame your biases and you're going to use it to frame your trades off of. Let's say that this was a 15-minute chart now and you see this in a bearish context. You see that it trades up into the premium order block. Well, that's a very good area to short. See my point? It's the backbone of your trading. You'd really need to get the PDA matrix and all the price arrays right. And when you're doing chapter 2, make sure that you find 10 examples of each array. When I mean 10 examples, I mean 10 bearish ones and 10 bullish ones of mitigation block, 10 bearish and bullish breakers, 10 bearish and bullish fair value gaps, 10 bearish and bullish order blocks, 10 bearish and bullish rejection blocks. Now it sounds like, oh my God, that's a lot of work. Yeah, doing that, right? Training your eyes to see it. You don't have to do it every single time. Once you train your eyes once to see it, it will stick with you for some time until, you know, you just don't do it for a very long time. Maybe then you can forget it. But it's about sharpening that skill. You need to be able to open the chart and see, you know, the price raise. It should be jumping out at you. Yeah, it gets in your subconscious essentially. Anyone else have any more questions? Anything chapter 2 related? If not, then we're just going to keep moving on. If you have a question, I know sometimes maybe you guys, yeah, go on, bro.
If there's multiple arrays in a section, which one would you look at?
Okay, this is a good one, right? Now, in chapter 4, I touched on this in more detail. What you're doing is you need to exercise your patience, right? When you trade up into the premium, you're hunting for something called a displacement, right? Now, you don't just wait for it to go into a, you know, so if we just remove this, right? So you have this fair value gap and you have this order block and this rejection block. Now, it's not just, okay, I'm going to go to the order block and short. That's nothing. This is the beginning of your framework. And chapter 4, it touches on this perfectly, right? I made very in-depth PowerPoints as well for chapter 4, touching on this perfectly, right? You need to wait and let price get delivered into these premiums first. Now, be aware of every single price array. You're monitoring each price array as it gets delivered to. What you're waiting for is clear confirmation that this price array is going to offer a trade. Now, what would I look for? Let's say that it's a daily or 4-hour a daily or 4-hour array. When it gets traded into on the 5 or 15 minute, right? On the intraday time frames, right? What I'm waiting for is when we trade into it, is there a market structure shift away from it with displacement? Now, displacement is touched on in chapter 4. Displacement essentially is, you see like these big candles that leave fair value gap. It shows clear direction of where they're trying to take, price. Do you see my point? Like, whoever's a thing that is, can you mute it, please? Because it's relaying a lot. Thanks. So like these candles that leave big fair value gap, right? That's trading in the direction of your buyers. This is what you look for, because what's this candle showing? It's showing displacement, a willingness to go towards your drawn liquidity. Specifically, you want to see these displacements happen in your areas of premium and discount, right? This is a confirmation that we look for. The displacement essentially shows, right? I call it, right? And I think there's another guy online, he's called it that as well. It's like a smart money footprint. Smart money, they cannot hide themselves entirely from the market. When they participate, there is displacement that occurs in the market. They cannot hide that. They leave the fair value gap because their orders are so big, right? When you see, right, the order flow is pointing towards bearish prices and whatever, and you're in a level of premium, and you see that displacement away from it. Now, on the 15-minute, when you see that displacement, right, and you see something like this away from the order block, right? So you trade into the order block here. So let's say you're traded down here, right? And now can you mute your mic, please, bro? So let's say you see something like this, right? And you're just making your way. Be very aware of how I'm making my way up into the premium of this range, right? So now look, we're in the premium, and you might just go like consolidate a bit, right? And you might be hunting like a power of 3. So you go like this, higher, and then lower, right? So when you come into the premium of this range here, right? In this, let's say it's this here, right? So this is like a fair value gap on the higher time frame, right? So let's say this is a 4-hour chart, yeah, and you're trading up into it. Now, if we go like this, we see that this is in the premium of the range, right? Now, what you're looking for is this, right? You're waiting for this signature to happen, the market structure shift away from the array, right? So when you trade up into it, you go higher and lower. That's a market structure shift, and it will leave a breaker. So it goes high, low, higher, lower, low. When it does that, right, that's the market structure shift here. You went higher, high, and then on the retracement, lower, low, right? You use this run on stops here. That's the idea behind the market structure shift. You're using the run on stops here to facilitate offset distribution of smart money shorts to go lower. You see this price leg here, this price leg here, this, you want to see displacement in this price leg away from the array, right? So this is at your 4-hour array. This is something on that 5-minute or something that you want to hunt for, right? You see displacement away from here in this part of the market structure shift. When you see that, you can get, OTE of this, right? So you can wait for a retracement entry, right? Somewhere into here, right? Now, when you want to get short here of this range, you want to get to the 50% or anywhere above it is a great short to get short on of that range, right? That's how we use the price arrays, right? You're monitoring each price array. So there could be fair value gap, right? There may be order block higher up. You're waiting for this signature to occur off of your higher time frame price array. Specifically though, you want to give attention to the displacement, right? The displacement is the key that you're looking for away from your higher time frame price array. There is a proper PowerPoint I made with proper slides and explanations and everything in chapter 4, going way more in depth about entries and displacement and everything. So when you get there, it will probably make more sense. If you want, if this makes sense to you, you can take a screenshot of it if you want, or you could just watch the pre-recording again. But does that answer your question, bro?
Yeah.
Cool.
So once that happens, you're sure it won't hit an array above it.
So when you see this happening, right? When you're seeing this happening, and you see the displacement happening away from it, right? Say this is like a daily chart, right? Or this is a daily. If this is like a 1 hour, for example, like a 1 hour displacement, because the displacement on the 15-minute is probably going to cause a displacement on the 1 hour as well, how they're interlinked, right? This is what you're looking for. Now, this is the only model that you'd probably need. Now, if it goes up and trades again into the price array, and like takes the other price array, considering that this is the premium already, it's probably going to go and take the price of the external high. Your stop loss goes here. Why? Because your stop loss is in a level of invalidation. Remember, there is no 100% success rate, right? This works like a charm though, if you can wait for this. And I know there's many guys in the mentorship already. I don't know if they're in here. This is the model that they look for. This is a simple model that they trade, and it works wonders for them. Let's say there's a fair value gap here, like a 5-minute, there's a clear fair value gap within this part of the range, right? Like something like this. When you see that market structure shift and there's a fair value gap left in here, get in on that fair value gap. That is one of the models that I use. That's probably my go-to model that I fall back on. It's that market structure shift with the OTE specifically into the fair value gap. That's the one that I personally look for.
And this is minimum 1 hour time frame.
What, the displacement? No. The displacement.
This whole model.
The model is fractal. The model is fractal. This could be, you see this, right? What we're showing here.
Mm-hmm.
What we're showing here, the fair value gap and this price, this is like maybe your 4-hour chart. What you're waiting for is, it doesn't have to look exactly like this, but the criteria is this. You need a 4-hour PDA matrix, right?
Yeah.
Now, when you have that, you need to discern your bias, right? Now, if you're looking to short, because the higher time frame biases, the daily and the weekly direction is telling you to be a seller, what you're waiting for is, you're waiting for a retracement back into your array, your premium arrays. Why? Because you're only looking to short from premiums, right? Now, when that occurs, you're hunting for this off of an array, right? You don't just take the first array. You're taking the first array which this is offered at. Do you see my point? Because this could be offered at the fair value gap, or it could be offered off the okay, yeah, enter on. I don't know how to remove this as also, if you can remove that as well, bro, because it's gonna stay here. Oh, it's for your screenshot. Yeah, go on. You see this displacement that you're hunting away from it. Let's say it's a 4-hour, right? Because this is how you need to link the timeframes logically. Yeah, it was you, Jack, that asked, isn't it?
Yeah.
All right, cool. So let's say this is a 4-hour, right? The displacement that you're hunting for could be on a 5-minute chart. Do you see my point? Now, if it's a daily, maybe if this is a daily level, maybe you'd want to take a 15-minute displacement over the 5-minute, because you see how the 4-hour is lower than the daily. So you'd elect to use a 5-minute. And if it's a daily level, maybe you should elect to use the 15-minute. Do you see my point?
Yeah, to be more sure.
Yeah, that's it. That displacement, right? Now, 1-hour arrays, yeah, once the draw on liquidity is so clear, right? When I mean like you can see that where the daily target is getting hit, like it's going for that low, and there is, clear 1-hour arrays. I mean, I'd always use a 4-hour. I wouldn't really fall back to a 1-hour, but if the 1-hour is very clear and from the 4-hour, you could refine it, right? Because sometimes there are bending of rules. This happens in trading, right? If the 1-hour is really clear and there is a clear array that you can take it off, by all means, take it off the 1-hour array. but you're hunting for that 5-minute rejection displacement, right? That's it. That's literally it.
Yeah, makes sense.
Sweet. Anyone else got any questions? Because I have to run at 10 and we have half an hour. I have to run at 10. Is that it for chapter 2? Anyone got any questions for chapter 2? Breaker blocks, mitigation blocks, any of that? No? All right. What about chapter 3? Okay, wait.
This might not be part of chapter 3, but this kind of is with the frames of it. You know the cut bar chart.
Yeah.
Can you go into like how you use that?
All right, sweet. All right, we'll do that. Let's just answer this guy's question about rejection blocks, and then I'll do that, bro. So the rejection blocks I like to use, yeah. Now, the rejection blocks, you have to realize one thing. Rejection blocks are only at the high and the low at the range. They are the price arrays before the run on lows and highs. This is a rejection block. Now, why do I love this one as a rejection block? I'll tell you the criteria that I like for it. You see this wick in it, right? What does this wick do? You have to look at it a bit deeper. What is this wick doing? It ran this high, right? It ran this weekly high, right? And where was the rejection off of? Because the rejection block, I like the rejection to be off of something specific. Like, you know, I don't just want the wick to be in a random area, right? When I see that it's a high is created with a wick, I want to see, was that high rejected off of another price array, or was that high a run on stops, which then, you know, wicked the other way and created a high, and now we're trading away from it. That's the rejection blocks I like to see, right? I want to see the rejection block reject off something, either in array, right? So you see how you had a fair value gap here. You see how it closed that fair value gap, right? This candle from this candle's low, right? You see how it closed that fair value gap perfectly, and we wicked away. That created a rejection block. It rejected off of that high time frame array, and it created a high. That's the rejection blocks I like to consider. Even on a 15-minute chart, on a 5-minute chart, the same thing applies. If you had something like, again, if I go like this, you just have some consolidation, yeah, and then you got this higher, and then you displaced away from it, and then there's a lower low, and now you're just going down like this, right? You see this high created. If this high is wicky, do you see my point? Because look, it's clearly run these highs, and it's off of this, some array off of this in the premium, and this is a wiki, you know, this high was created through a wiki candle like this, right? That's the rejection blocks I like to take. Do you see my point? That's the criteria I look for rejection block. If it doesn't have that criteria of running, you know, liquidity or rejecting off of an array, I don't like to fall back on them, right? You wanted to go over the COT data, right?
Yeah.
Yeah, sweet. Okay, cool. So this is the COT data. The way you use the COT data, right? And this is in chapter 5, so it's a lot, you know, way more forward than where this Zoom is meant to be, but we'll go over it. What it does is it tells you the positioning of the players that are participating within the market. Why is this useful? Because which players are we trying to get in line with?
The common traders.
The big commercial traders, right?
Yeah.
The blue line is retail speculation, right? And you see how their positions are barely nothing, like they're just always around the mid figure. The green is like your small financial firms, hedge funds, you know, hedge funds vary, they could be big ones or whatever, and like small pension funds, you know, insurance funds, whatever they are. The big boys that you're considering are these guys, right? These are the guys that you want to consider. Now let's talk more about it. What these guys do is they help solidify your bias, right? So you see how, so what you do is like this, you know, you get your horizontal, and you see the price here, you're trying to get it onto zero, right? So get close to zero. So like this, yeah. And then when you right click on it, it's gonna come up like this, change it to large, change this to 0, 0, and apply it. That's it. This is now your neutral line, right? This is at 0. Anything above that is a net long position. Anything beneath that is a net short position. Even when the net short, even when they're increasing here, doesn't mean they're long. They're still net short. It's just their net short position is, you know, eroding away. They're like, it's lessening and lessening and lessening, right? And this is how you see what smart money are doing in the market, with especially with hedging. You see in this upwards move here, right? What are they doing within this whole entire upward move? What are they placing in within their market, within their position? Sorry, are they placing long positions or short positions?
Short.
Short positions. Now let's add some more context to this, right? Because this is where people they don't apply like sound logic to it. When they're adding their short positions to it, they're hedging a position. What are they doing? Every single time a high is run, what are they doing? They're shorting to the
Placing
people above the
shorts.
high. Do you see my point? You see all the buy stops here, when they triggered all the buys, they're shorting to them, right? They're shorting to those people. Now, you take this, right? This is a daily chart. It's always a daily chart here, right? This is always a daily chart. The 3-year is showing the positions of the commercials and speculators and the small institutional firm, small
How long
financial
are
firms.
how long are they holding these shorts for?
So with smart money, right? ICT says they don't even have to use a stop loss. Their pockets are so deep that you just they can take a drawdown. They could take drawdowns for months. I think in one video he said it for years, right? Because their
they
risk
eventually
management.
know they're gonna win.
Yeah, exactly. Because they hedge their position. They're not like stupid over leveraging these trades, by the way. They're hedging it. They're placing in smart, you know, percentage based sizes of trades into these, you know, highs and lows when they're hedging their positions, right? For when it turns over, it's going to go in their favor. But when they're hedging their position, right, you need to pay attention to it, because it's showing that when they're net short, you're just like this. Okay, every single run above the high is probably going to, one of these are going to offset a market structure shift, and they're going to get short on it, right? This is just showing that a short is coming, right? They're using highs, yeah, because people are going to be like, but if it's net short and it's going higher, why does that make sense? Because they're just pairing their short positions, yeah, with all the buy side liquidity, and this market is going to flip on itself, is essentially what it's going to tell you, right? It's just going higher and higher and higher for their shorts. You can be a buyer in here because this is a daily chart, right? You can be a buyer in here, but just be very careful when the market structure shift happens to not get caught offside. This is how you know, because now when the lows get run, you know that, okay, cool, this is the short position being filled in by smart money. Do you see my point? Right?
Yeah.
Now let's look at it here. From 2020, they've been net short since 2020. You see from here, yeah, the third month, wait, what? Yeah, the third month. So March of 2020, they've been net short on Euro USD. That was, I think that's prime time COVID, if I'm not mistaken, right? They've been net short on it. So that means essentially they're long on the dollar, right? Now what's happening now is this is the first time we're getting above the zero and a net long position is being made. So, you know, right, and this is very critical, like it's very critical for analysis, like for long-term analysis, because if this net long position keeps getting built up here, and where are we on the euro? We're like, we're under
Borderline
many
one.
lows. We're under many lows here, right? If this net long position is going to get built, there is an insane trend line right here. If this high gets broken and the position is very net long, it can tell you when the the shifts in market structure is going to come, because you have this data to back you that yes, it's long. You should be waiting for longs, right? And even better, if this breaks this high and on the retracement down lower, when it's retracing lower, when you see that position build up on the retracement lower, It just shows you that, okay, wait for a discount to be, they're waiting for a discount. So I'm going to wait for a discount because they're building that long position. Do you see my point? That's how you use your quad data. It's very, very powerful. Because when you see these retracements higher, yeah, on a down market and they're still net short, you know that they're just still building a net short position. It's more likely to just deliver into a premium and go lower rather than run the high, because these guys are net short, they're not net long. Do you see my point?
Yeah.
Sweet. Anyone else got any questions? Any questions to do with chapter 3, maybe like a kill zone, or like the relationship between a kill zone, how to use the PDA matrix to, you know, kind of go and understand the relationship between expansion and reversals between the kill zones. Chapter 3 is pretty extensive. I think that's the longest chapter. There's 8 videos in it because the intraday stuff is very you can call it delicate. It needs to be taught in a very broken down way. There's a lot of moving parts within the intraday teaching stuff. The London Judas, yes, sweet, let's do that. Okay, so the London Judas, yeah. So today was a good example of the London Judas, right? Now you see on the DXY, you see my internet's bad. So you see on the DXY, if you go on the daily chart, right, just for context, you see when we swept these highs, right? You see the Monday, it swept the highs and it clearly rejected down. I remember then we were looking for like shorts, right, into this fair value gap. On the euro, if you're looking for longs, this is how you will look. This is how you will look for longs. Yeah, the London Judas is going to be it's in conjunction with Asian range. So let's look at this with, you know, more of a magnifying glass. If we go on the 15-minute, what you need to do for London Judas, right? Let's touch on a few things here. The first thing you need to do is outline this, right? This is your midnight opening price. This is going to be your, you know, your measure for being a buyer and seller. When you want to be a seller, you want to get beneath the midnight price. When you want to, I mean, when you're a buyer, you want to be beneath the midnight price. When you're a seller, you want to be above the midnight price. Then the question to the trader is how above or how beneath? That's the next logical question to ask. Would you agree or not? All right.
Yeah.
Yeah, sweet. So then if we do this, right, we use the Asian range for a measure of protraction. So if we go to here, right, that's one. And this is the high, right? So this is the first measure of protraction that you're going to use. Now, when you're looking to short sell, you want to be beneath the midnight opening price. That's fine. One measure of projection we can use is I want to be beneath the midnight opening price and beneath the Asian range, right? And how you want to do it is like this. Have your midnight opening price and look here for something logical to run, to, you know, measure the run on liquidity with, right? How many lows are there here? 1, 2, 3, and 4. There's a quadruple equal low here. You see this one here. And if you go into the 4 hour, I'll show you. This is what in the Telegram group chat, this is what we were looking at. Right. What's this that I lined up? Which price array is that?
A fair value gap.
It's a fair value gap, right? Now, that 4-hour fair value gap, you're going to keep on your chart. You're not going to remove it, right? Now, you see how we have these lows and we have an array, yeah? And it's all beneath midnight opening price. And let's say you want to be long on it because on the euro because you're short on the DXY. Okay, fine. What you're doing is you're finding your area that makes sense to become a long trader, right? Run beneath the midnight opening price, number one. Asian range, 2, right? And then you have the CBDR as well, right? If you want to go over the CBDR, it's essentially this. It's another measure of protraction that we use as traders. So you use the price from 2 to 8, and you find the highest and the lowest price from 2 to 8. So this is the highest price. This and this is the lowest price. Right? So this is the highest price, this is the lowest price. And then what you want to do is, first of all, you want to do this. This is how I like to do it. Measure this out, right?
Someone asked if 2 to 8 is in UK time.
It's all New York times. Whatever I'm saying, look, my time is UTC -4, New York. That's the only reference to times I give, right? They're all relative to New York times. Now measure this out, this box, right? So it's at 17 pips, yeah? 17 pips. How, you see on a daily candle, what's an average daily range? The average daily range is usually like 100 to 120, right? How much off that are you going to give to the Judas swing, the low, the opposite end of the candle? This is how you start to frame it. 30 to 40 pip protractionary move, right? You're looking for like a 30 to 40, some people say like around a 30 to 50 pip. So we know that each one of these there, let's say that each one of these show 15 pips here, just minus the 2 pips from the 17, because I like to use numbers in 5, right? So that's 1, right? And I like to use usually 2 deviations of the CBDR. And 2, right? So we know that this is like a 30-ish pip protraction, right? This is a 30 pip protraction using this central bank leaders range, and it's in a clear consolidation, which you want it to be. Now you see how it lines up with this fair value gap. You see that, right? That's what you want the CBDR to do. And it lines up with the run on the liquidity. You see the bottom of it, how it lines up with the run on all of this, right? Now, it doesn't mean it's going to come here and just thing you. It gives a range of where is price likely to go to, and the CBDR is very accurate. The way that it's used is like an average, right? You want to give 5 pips of leeway of this with where price is going to slap in the opposite end of the range. If you want, we can measure it from here. So it's like 8 pips was the difference between the central bank leaders range deviation and this, right? And you see how it's in the fair value gap. So all these things point towards considering the run on this low into the fair value gap. That is what the Judas swing is. In the UK time, just plus 5 hours to what I said. So every single time that I say, you have to just add 5 hours onto what I said. So the CBDR is from 2 to 8 in New York time. So just add 5 hours to each side. And Asian range is 8 to midnight. I highly recommend just learning them in this. It will save you. I remember I was a bit reluctant to do it as well myself, but it's just a lot easier when you do it to New York time. The times just make more sense. This tells you to consider this array of the fair value gap. It's feeding inside of it. So what you do is, right, you have your logical framework now, right? This is how my chart usually looks. I'll have the midnight price, I'll have Asian range, and I'll have a CBDR, right? Now, the arrays, I'll have them marked out like this, and I'll have them, labeled if I need to have them labeled, right? And I'll consider that this is a 4-hour fair value gap. Now, price trades into here on the 15-minute. Sweet. Let me show you what it looks like on the 5-minute. And I know a few of you caught this trade today. And it was, simple market maker model. You see how we're just trading down, right? You were trading down and we're coming lower and we're coming lower. And you see now we trade into this fair value gap. This 4-hour fair value gap. What you need to do is you really need to pay attention to lows and highs. Yeah, low, violated. When this low was violated, what happens? Look at this move. Up, right? What does it do? It's breaking these highs. Now you have to look at it in the context, right? You have to look at it into the context. We are in a discount of the day. We're under the midnight price. That's one thing to consider. We're really under midnight opening price intraday, right? In a bullish, bias. This is where narrative matters. In a bullish day that I'm expecting to expand upwards because the DXY ran a high and is, rejected off of it. I'm expecting higher prices on euro. The day that I'm in, I'm under the midnight price by quite a lot. Specifically, I'm in a discount 4-hour fair value gap array, and I'm under a sell side liquidity pool. Sell side liquidity has been taken out, right? Now, this narrative, right? Low, high, right? This is your market structure shift. High, lower low, higher high. What you're waiting for is, me personally, I'm trying to get OTE to this low. So first I'll go on this high. It's not offered, right? There's no OTE offered. That's fine, right? It won't. Sometimes they don't get offered and you don't take a trade. That's fine because you're only looking for high probability. Now look at this one. Put on this high, and I think this was at 8:30. Yeah, 8:30, 1:30 time in New York. This is prime time where you expect a retracement to happen. Where does it go into?
This is exactly the same time as news as well.
Yeah, exactly. This is why you'll see how many news events are there at 1:30. You'll be surprised. Most of them are at 1:30, by the way, or for red folder news on USD news, right? There's this fair value gap here, and what is it? Right? It's OTE. Is on way under here. If I just go, let me just go here, show you guys. You see how it's optimal trade entry, right? This area here is optimal trade entry. Boom, right here into this fair value gap, right? So you could enter at the start of the fair value gap. Stop goes at the here and there. Now, when it comes to market structure shift, I always try to get optimal trade entry off the market structure shift. The reason being is because of this is my thought process behind it. I'm trying to get as close as possible to that low, right? I'm trying to get as close as possible to that low because I'm assuming now that is going to be the swing point. And it was. This is now the 4-hour swing point, right? That market structure shift that happened off this specific discount array, right? It's the context behind this that matters. It has to be in the correct context. If there is no correct context here, you need a logical institutional support level to find this specific pattern. What is the specific institutional support levels? They're your price arrays that I've taught you guys in chapter 2. Without that, this means nothing if you're finding it just anywhere. You need to find it in specific context. And then, right, if you just look to get OTE from the low to the highs made, right? So it will be this high first that you use. It's not offered, cool. Anchor it to this one, cool. OTE is offered, sweet. Look, stop goes here, and you're aiming for, a buy side objective like here, or maybe like a fair value gap. That's it. That is it. That's all you can use. You just need to practice finding it in its narrative. That's it. How many the guys that's been with me in the start of the mentorship, they will tell you, yeah, this has happened probably 50 plus times. 50 plus times from March until now. We've seen this happen week in, week out, sometimes day in, day out in the market. This is what you're looking for. The run beneath midnight into your discount. Look for this to happen at your specific institutional support level. OTE off of it. That's it. Does not need to be complicated. That's essentially a model, by the way. The midnight price used as a TP, I wouldn't use it as a TP. The things I'd use as a TP is, an opposing PD array, or I'd use like this high, for example, or if you see like a consolidation here, you see this initial consolidation, target the high of the initial consolidation, or leave a runner to at least go for it. That's what I'd do. But yeah, that covers quite a lot of chapter 3, to be honest. CBDR, the midnight price, PDA, using the PDA matrix to form it, right? That's how you're framing your reversals, by the way, intraday. Intraday, if price is trading down into your discount array for a bullish scenario, you can expect a midday reversal, which is what you saw here, right? Midday reversal only when it trades into a logical support level of like a PDA array, like a 4-hour fair value gap in this example. And when you see this, you're expecting it to have a midday reversal. And this is the Judas that done it. But yeah, it's unfortunately it's going to have to be it for this Zoom session. I have something to do a bit after 10 o'clock. But is there any last question, like a short question that we can answer probably before 10?
Oh yeah, you see for London, the London session.
Yep.
What times do you consider the London session? Because I think ICT said like UK time 7 to 9, something like that.
Nah. He doesn't say 7 to 9. The two times that he says is this, right? He will say 1 to 5. Right, that's one time he'll say 1 to 5 or 2 to 5. The ones that you consider, I say consider is 2 to 5. The reason being, the reason why he done 1 to 5 was to make up for daylight saving time, but we're not in daylight saving time. We use the 2 to 5 is the one
What's
that
day what saving time?
daylight savings time is, the change in the hour.
The audio cut out. I don't know if you can hear me.
You know when there's like the hour goes back and stuff. Like in the winter the hour is gonna go back in it. Can you hear me? Wait, can you guys hear me or?
Yeah, I can hear you. So
Yeah.
when the hour goes back,
That's daylight. That's called daylight savings time, isn't it?
Yeah.
Yeah. Just use the times 2 to 5 for the London Open and use 7 to 10 for the New York Open session. Those are the ones that himself in the weekly commentaries, when we were learning from him, those are the ones that he gives references to as well.
Sorry, can you just say that last 10 seconds again? The mic just cut out still.
Use the 2 to 5 London
Yep.
Open and use the 7 to 10 a.m. London Open, New York Open. Yeah, in the New York time the New York time, UTC -4. That's
Yeah.
the ones that he as well, when I was learning in the weekly commentaries, daily logs and whatever, that's the time references that he gave as well. 2 to 5, 7 to 10, right?
Right. Yeah.
Sweet.
One last question as well. Is there always a Judas swing?
There always a Judas? There is always a level of Judas swing, right? Because you'll see price goes,
It has to make opposite ends of the
yeah, it
range.
will make an opposite end of the range, right? You see the
Yeah.
daily, just the way a candle works. Sometimes, yeah, don't get me wrong, it could just create a liquidity void and just go push one way. It's very
Yeah.
unlikely though. You always okay? The answer is no. There doesn't have to be. Realistically, no, there doesn't have to be. Logically, do we need a Judas swing to trade London? Yes. Do you see my point? You need that Judas swing to trade London.
Mhm.
But yeah, that's going to be it for this one. If you guys got any questions, because I know sometimes it's asking a question in front of some people could be a bit challenging. Ask me in PMs. It's completely fine. Yeah. All right, cool. I'm gonna stop the recording now. Yeah.
Safe, bro.
All right, cool. Take care of yourselves. Yeah.
Have a good day.
Yeah, you too, man.